Good evening, everybody, and welcome to our webinar this evening. My name is Chris Entz. I'm an advice-only financial planner and a member of the support team here at Advice. Thank you so much for joining us for our case study webinar. Today, we're talking about CPP and OAS timing, which will be a lot of fun. If this is your first time here, welcome. We want these sessions to be as helpful as possible, so we really encourage you to ask questions as we go along. Owen will guide us through some fundamentals and some case studies, but ask questions and I will funnel them through to Owen in the cracks. So if you can use the Q&A function in Zoom, that's always the best. That's what I'll be watching for. So thank you so much for joining us, and I'll toss things over to Owen.
Great, thanks, Chris. So yeah, my name is Owen. I'm an advice-only financial planner, CFP, and the founder of Advice. And of course, Advice is an easy and powerful retirement planning platform you can use to build your own retirement plan. Now, in addition to the software platform, the AI strategies, we've got our community forum for support, and these webinars, which we do every 2 weeks. So we do two every month. This is the second of two webinars we do in the month. The first one's more of an open office hours webinar, and this one is focused on a particular topic. And this month it's going to be around CPP and old age security, specifically looking at when to start those benefits and how to evaluate that within your own retirement plan. Now, of course, this is an interesting topic because um, amongst all of the things with retirement planning, CPP and old age security are the two things that are fairly constant within everybody's retirement plan in Canada. Of course, there are some exceptions, but for the most part, if you're retiring in Canada, you will have these benefits, and the timing of those benefits, when to start them, is an important decision within everybody's retirement plan. So, this is going to be an interesting webinar because we're going to look at things like survivor benefits, survivor scenarios, CPP break-even analysis, some of the pros and cons with when to start your CPP benefits. We'll try to cover as much as we can, but of course, there's a lot of nuance with this topic. I'm going to bring up the slides here. We're going to go through some fundamentals first. Then we're going to go through a couple of case studies as well. So the topic again is when should I start CPP and OAS? We're going to help you set up some of these examples within your own retirement plan. In particular, the break-even analysis. I want to show you how you can set that up with your own retirement plan in Advice. So we'll have a couple things we're going to go through. Fundamentals, so just ground everybody in the fundamentals of CPP and OAS, how they work, how we might see that impact the case studies that we're going to take a look at. Key considerations for the timing of those benefits. So just a couple of the things you might want to think about. There are a lot of things. These are the softer factors. We'll go through some of the financial, mathematical factors, but this will cover some of those softer factors. We'll go through the finding the break-even point. Now, this is interesting because everybody's break-even point is different depending on the reality of your plan, the type of assets, your rate of return assumptions, asset allocation, investment fees, lots of factors there, and I'll show you that. And then the last one's around benefit timing, survivor scenarios, how you might make different decisions on CPP and OAS timing depending on longevity assumptions. Now, this is for couples and individuals as well. So even for individuals, we recommend running survivor scenarios to see if your plan changes if you were to have a shorter life expectancy. Now let's start off with some of the basics here. So Canada Pension Plan, really based on contributions. So to estimate future CPP benefits, we need both your past contributions as well as future income assumptions. And so you can start making contributions to CPP as early as age 18. And all of those contributions are based on your employment income. So if you don't have employment income, you're not making contributions, unfortunately. And to receive the maximum CPP benefit, for the base benefit specifically, we need 35 to 39 years of maximum contributions. That would be earnings above the year's maximum pensionable earnings, the YMPE. So if you're earning above that level, you get a full credit towards CPP. We need 35 to 39 full credits to get the max base CPP benefit. Now, the interesting thing is the enhanced CPP, CPP2, actually requires 40 years. Regardless of when you started, it requires 40 years of maximum contributions. And there is an additional income threshold with CPP2. That's the additional years maximum pensionable earnings. So if you can get the most out of CPP, you're earning above that additional years of maximum pensionable earnings for 40 years. Now, old age security is based on residency. So you, between 18 and 65, Residency in Canada will count towards old age security. We need 40 years of residency to get the maximum old age security benefit. So if you spent time outside of Canada, if you immigrated to Canada later in life, that'll be an important factor. You might have a prorated benefit there. Now, OAS clawback is the other factor that we're going to see come up. Old age security clawback, or the actual name, the recovery tax, it does affect retirees who have started old age security benefits, who are over 65. And it's 15% of income above the threshold. And the threshold right now, 93,454 in 2025. Any income above that threshold, taxable income specifically, will cause clawbacks. Now, the interesting thing is it's based on individual income. So, unlike other income tested government benefits, guaranteed income supplement, for example, GIS is based on household income, but old age security clawbacks are based on individual income. So, you can have one person and a partner triggering old age security clawbacks, and the other one may not. Now, OAS clawbacks, not a concern if you've got taxable income under 93,454. This would be line 23600 on your tax return. Then you get full old age security. So most retirees will get full old age security if you've got 40 years in Canada. On the other end of the spectrum, if you have taxable income above the maximum threshold, you get no old age security. It's entirely clawed back. This threshold changes every quarter. It's based on the increase in old age security, which happens on a quarterly basis. Right now, it's around 152,000. It goes up at age 75. The reason being old age security also goes up by 10%. So that actually increases the amount of income that you can earn and still get a little bit of old age security. Now, in between, you could experience some clawbacks. Now, I'll give you an example of how that can happen. So Jesse, let's say Jesse in retirement has $100,000 of individual taxable income. It could be from RSP RIF withdrawals. It could be from a pension. More likely than not, though, it's usually when it comes from a capital gain of some sort. So it could be the sale of a cottage, rental property, maybe a lot of shares that need to be sold, liquidated for whatever reason, employee shares. Typically, this happens during a large capital gain. And so maybe Jesse's had a cottage sale or a rental property sale, has lots of income for 1 year. And so if the income's above that threshold, we have, in this case, $6,500 above, and then we just multiply that by 15%. So Jesse unfortunately loses $1,000 almost in old age security. So that's how the clawback gets calculated. It'll definitely impact an OAS break-even point. So this is why this ends up being important. If you are expecting to sell a cottage between 65 and 70, a rental property, if you're expecting to trigger a lot of capital gains on a non-registered portfolio, maybe make really large RSP RIF withdrawals, maybe you're melting down an RSP, you've got a really big registered account. This is important. You'll probably see in the platform pushing the AI strategies, pushing for a later OAS start age, maybe to avoid some of those OAS clawbacks. So between 65 and 70, if you are going to trigger OAS clawbacks, I suspect you'll want to maybe think about delaying old age security. So that'll also factor into your break even. Any questions so far, Chris?
Yeah, question about OAS clawback. We actually had the same question twice. So people are curious about how income splitting factors in. So if they're splitting income with their partner, how does that factor into the OAS clawback calculation?
Yeah, good question. So that can help you avoid old age security clawbacks. So yes, if you're making withdrawals from a RIF after 65, if you've got pension income, that can help you avoid OAS clawbacks. So it is fairly difficult to hit that OAS clawback threshold. It typically does happen if there's a large capital gain, which maybe can't be split because it's one person's property and not the other. But again, every plan is unique, every plan's a little bit different. That's why we want to run the AI strategies and look for that OAS break-even point. Yeah, good question.
Thanks, Owen.
Now, we're also going to talk about survivor benefits. So after death, CPP, we have the one-time benefit, CPP death benefit, not a lot, $2,500. We have, if you have younger children, you've got a child benefit, CPP children's benefit. If they're under 18, they would get this, or if they're under 25 and still in school, so full-time school. Not a lot, $300 per child per month, but that's available as well. The big one that typically comes up in a retirement plan is going to be a CPP survivor benefit for a surviving spouse. So that amount is based on the calculated benefit at 65. So let's go through a bit of an example here. Let's talk about how that gets calculated. The survivor benefit, it really is based on the calculated benefit. So if you are the deceased, it doesn't actually matter when the deceased has started their CPP benefit. They could have started at 60, 65, or 70. To the survivor, it doesn't matter when the deceased started their benefit. The survivor amount that they're going to receive is always based off the calculated benefit as of age 65. So it does take a little bit of pressure off this when to start CPP, because if there is a survivor situation, at least for the deceased, it doesn't matter when they started their benefit. So the amount that the survivor gets, it depends if they're under 65 or over 65. If they're under 65 and they haven't started their CPP, they'll get a flat rate benefit plus 37.5% of the deceased spouse's 65 amount. So again, that calculated amount. If they're over 65, they'll get 60%. There's no flat benefit anymore. It's 60% of the deceased partner's CPP benefit. Now, the other nuance here, which often causes problems, is that there is a combined benefit. So once the survivor starts their CPP, there is a combined calculation. The combined amount can't be more than the maximum for an individual. And this does cause a lot of problems because you can have two people with close to the maximum CPP benefit, and they will see a very large reduction due to this combination. So a very important factor to keep in mind, especially if you've got maybe a spouse or partner who is younger or older, that's going to play into this strategy quite a bit because of this combination. Now, even if you're below the maximum, there is still another reduction that happens when the survivor starts their CPP. So if you're getting a survivor benefit, when you start your CPP is a very important decision beyond the scope of this webinar, but something to think about. Any questions so far here, Chris?
No, not so far.
Okay. So let's go to the next slides here. Old age security. There is no survivor benefit. We're going to see that in the second case study. No survivor benefit. Very important from a break-even analysis because there really is no survivor benefit for old age security. And then for the platform, we're going to walk through a bit together, but on the Adviice platform, we just need to enter our years of residency in Canada to help the platform calculate old age security. And so that's why we asked for that question in the tax and benefits section. We also do allow you to enter your CPP statement of contributions to help calculate CPP. We do encourage that because it is more accurate. It does give us a very accurate estimate of your future CPP benefit because we can use your past contributions and future income assumptions. So we can get a very good estimate of future CPP, including enhancement, as well as any dropout years. Now, the reason we don't have to do that. The other option is we do have a simple mode. You can just plug in your CPP benefit as of age 65. So in the tax and benefits section, you can do that. We don't recommend it, or we recommend starting there, but at least coming back and adding the detailed estimate. I'll talk about why in just a second, but you can definitely start with just a simple CPP entry here. Now, why we like detailed, there's a couple reasons. Just more accurate. That's one of the main reasons. Gives us a very accurate estimate of future CPP, including enhancement. The other reason is we can include any future contributions. So let's say you retire at age 55. Service Canada may not know that. They definitely don't know that. And so they're assuming you work until age 60 or 65. When they give you that estimate on the Service Canada site, they're assuming you keep working until the day that you start CPP. However, the platform knows that you may not be planning that. It might be planning at age 55 or 60 retirement. So by doing a dynamic estimate, detailed estimate, we can include those future income assumptions. And then the last piece, of course, is we can dynamically change this if you use the detailed estimate. So if you want to look at earning a little bit more income before you retired, maybe another 6 or 12 months, it could mean that you earn an extra CPP credit, and that actually can boost your CPP for the rest of your life by quite a bit. So that will dynamically happen if you're using the detailed CPP estimate on the platform. Any questions there at all, Chris?
We had a question backing up a little bit. So, on the survivor benefit, if the deceased person had the child rearing dropout provision when they were collecting CPP, would that factor into the survivor benefit?
Yeah, so it's the calculated amount at age 65. I'm fairly certain, but not 100% certain that the calculated amount and the amount that would be used to calculate the survivor benefit would include that child rearing dropout. But I don't think I've been asked that question before, so I would have to double check and look it up. But um, I would 99% certainty say that yes, that's going to be included in the survivor benefit as well.
Great. And then the next question here is, in the platform, there are two sections regarding CPP starting date and retirement date. If I want to retire at 63 and start at 65, does that affect the projection calculations?
Yeah, so let's say that you retire at 63 and you've got 2 years of zero earnings, so 64, 65, or 63, 64. That is part of that dynamic calculation. So if you've entered all of your CPP statement of contribution, if you've entered all your past contributions, um, and the platform knows that you'll have two zero earning years there, then yes, that will get captured in your CPP at 65. It will also get captured in the other ages. So if you start at 63 or 64, um, it will factor in the fact that if you start at 63, those two zero earning years don't get included. So that could be one benefit of starting earlier is that you're not adding more zero earning years to your CPP calculation. So yeah, it's a good question and why we would recommend using a detailed estimate on the platform.
Great. Thanks, Owen.
Perfect. Now, the other thing we'll talk about, AI strategies. The reason why we really like the AI strategies for this type of conversation is that they will immediately evaluate every CPP and OAS start age for you. You can then evaluate that based on things like estate value, net worth, success rate, and then you can make a decision for your particular situation. And again, every situation is unique, based on investment returns, based on clawbacks on OAS that you might experience. Um, the AI strategies take that into account. So they're literally running multiple versions of your plan within a couple seconds and evaluating when the best time to start those benefits would be. Best from a financial perspective, but doesn't really capture other things. So we'll talk about some of the other things you might want to think about. But a good example here is that if we start early, we've got a maybe a net worth estate value 1.8 million. If we were to start later, it's all the way up to 2 million plus. So big impact from starting those benefits a little bit later. Now, if that's the right decision or not, there's still some soft factors to keep in mind. Success rate also goes up as well. What's really nice about this is you can start to really see the trade-offs between the different start ages, and where it starts to become interesting or less interesting. And everybody's going to approach this a bit differently. Now we're going to go into some of the soft factors, but any other questions on the AI strategies at all?
Not on the AI strategies, but two on the calculation side. So on the platform calculation. So somebody's asking they're on long-term disability and they know that the years that they're on it will be dropped from the calculation, but they're wondering how the platform includes those.
Yeah, good question. So the child rearing dropout and disability dropouts, so the CRDO and DDO, they're not included automatically on the platform right now. We do have a workaround that you can use. I think it's in the help resources. If not, we'll put it together. I do think it is for CRDO already, but we will be including that. So we're doing an enhancement to the CPP module. It will then allow you to enter years that are dropped out, either due to disability or child rearing, and then that'll get included automatically in your CPP calculation. For now, you can still back into it. Chris might be finding the help resource. If not, we can always look at it. Just post in the community forum and we'll take a look and find that for you. But yeah, good question. That can be a factor, and you'd want to factor that in if you're getting CPP disability and you can drop out those years. Yeah.
Great, thanks, Owen. Next question. If I start CPP/OAS living in Canada and then move to another country, how does Advice handle that?
Yes. So advice is definitely focused on if you retire in Canada. Retiring abroad, overseas, cross-border planning, very complex, lots of rules, lots of nuance. So I would really recommend speaking with somebody who does that specifically. Even Chris and myself, we won't do cross-border planning because it is a very nuanced area of retirement planning. Even depending on where you're going, how long, if you're coming back, lots of factors to consider there. I wouldn't even dare to get into it because it's so nuanced. I know enough not to even get into that area. So it's a good question, a very important question, but something that I would say requires a little bit more attention from somebody who does that on a day-to-day basis. Yeah.
Great. Thanks, Owen.
Okay. So we talked about CPP estimate, why we want that, AI strategies. Before we get into break even, why would we want to take CPP at 60? Some of the factors could include we just need the income. If we don't have financial assets or we don't have enough financial assets to consider delaying CPP, then obviously we're going to start that benefit earlier. So if we need the cash flow, if we want the cash flow, if we don't have other assets that could backfill that cash flow, if we want to delay CPP, then obviously we'll start it early. So definitely cash flow is a key consideration. Life expectancy is another really big one. So, if for whatever reason we expect a shorter, lower life expectancy, we might want to start CPP earlier. So, definitely delaying CPP favors a long life expectancy. If we have health concerns, if longevity doesn't run in the family, if there's been a past diagnosis that hasn't been good, we might want to start CPP earlier. So, that's the softer side. Definitely the platform can help with the financial side, but that's the side that maybe the platform needs doesn't know and needs to get included in that decision. Now, the other one is CPP, OAS, and GIS. So there are some strategies where if you are experiencing in the future clawbacks on guaranteed income supplement or old age security, there are some strategies where starting CPP early, even if you're still working, is attractive. And the platform will take that into account. It does the GIS calculations and OAS clawbacks. But that can be one reason why, even if you're still employed, you might start your CPP benefit early. It just reduces the clawbacks because you're getting a smaller benefit, getting it earlier, maybe maximizing your TFSA in the meantime. But that can be one often interesting strategy when taking CPP early, could be interesting. Now, there's other factors here. So let's say that, for instance, again, we're talking about adding zero earning years. If you retire at age 60, you stop earning employment income. If you're adding 4 years, 5 years of zero earning between 60 and 65, it does drag down on your CPP benefit. So even though you're getting an incentive to delay, even though your CPP is going up, it's going to go up less because there's a slight drag there from those zero earning years being added to the calculation. Remember, you need either 35 or 39 years to get max CPP, 35 years if you start at age 60, and you need 39 years if you start at age 65. So that can be the other factor. Starting CPP a bit earlier might be interesting if you've already got a bunch of zero earning years in your past contributions. And if you're doing a detailed estimate on the platform, it will take that into account. So it will take into account when you do a break even. Now, why age 70? So increased benefit, big one. If you take it at 70 versus 65, it's 42% bigger, which is quite attractive. If you expect a longer life expectancy, it definitely helps against longevity risk. So that can be another big incentive to delay CPP until age 70. If you've got family history that includes longevity, if you're in good health, you might make a bet on that good health by delaying CPP until age 70. So that's information you have that maybe the platform, a financial model doesn't have. So that can be another factor. It's also really good for inflation rate risk. So again, longer retirement periods, inflation rate risk ends up being a big factor. CPP being indexed to inflation is a good way to protect against that. Now, the other one, counterintuitively, it's also in here as well, is CPP, GIS, and OAS. So there is a GIS strategy, for instance, that would suggest taking CPP at age 70 is better. It can help you get GIS benefits for a period of 5 years. If you're right on the edge of qualifying for GIS, this can be a good strategy. It's the 8-year GIS strategy. We've covered that in the past on YouTube videos. And it can be one reason why you might delay CPP until age 70. Even though it might not seem like it's a good idea, it can help you maximize those benefits for at least 5 years, if not a bit longer. So again, lots of reasons why every situation's a bit different there. Now the last one, oh, sorry, Chris, go ahead.
No, we just had a question related to that. So somebody just saying, don't you lose the opportunity cost if you take your CPP at 70 versus 65?
Yeah, oh yeah, yeah. So we're going to go into the break even right now, but that's a great segue. Is that yeah, absolutely. There's an opportunity cost. So if you are drawing down on your investment assets as you delay those CPP benefits, those investment assets are no longer growing and providing a return. So absolutely, there's an opportunity cost. That's why we need to factor that in to your specific break even, um, which is exactly what we're going to get into next. So one factor here is asset allocation. So if you have a more aggressive asset allocation, if you have a higher expected rate of return, actually pushes out your break-even point. So the opportunity cost is higher if you have a portfolio generating higher returns. If you choose to start CPP later and you're drawing on your investments, if those investments are growing, then that's a bigger cost, opportunity cost. The opposite's true if you have high investment fees. If you have high investment fees, a conservative portfolio, a balanced portfolio, it actually favors you delaying CPP benefit because there's less of an opportunity cost. So the break-even point's actually earlier in those situations. And that's exactly why we want to run the break-even analysis. And I'm going to show you now how you can set this up in your own plan. So let me switch over here and then we will do this together. Any questions while I switch over, Chris?
I think we're staying caught up so far.
Perfect. So let me show you where we enter the data, and then we'll take a look at this plan. This is Mary here. So um, we can go to tax and benefits. This is where in simple mode, we'd add in the old age security estimate. So how many years in Canada between 18 and 65. In simple mode, we can just plug in a CPP benefit estimate. In detailed mode, we would go through and add in our CPP statement of contributions. So we'd go to Service Canada account, we'd log in, get the detailed pensionable earnings for each year, enter that, and allow the platform to calculate it dynamically, takes into account zero earning years, etc. In this case, we're just going to use the simple mode. We're going to do a simple break even. So let's go, investment plan. Just want to highlight this. So we're going to start. The first example we're going to do is with Mary having a fairly balanced conservative asset allocation, 60/40. So a typical balanced mutual fund at 2% fees. So high fees, low expected return gives us a 3.39 expected return on Mary's portfolio. So fairly low is going to be our first example here. And then the other thing to show you in foundation, we've got the CPP and OAS estimate. So this is going to show you your CPP at different start ages. So if you started CPP at age 60, this is how much you would get. At 65, this is how much you would get from that point going forward in today's dollars. And then at age 70, this is how much you'd get starting at age 70 going forward again in today's dollars. So obviously it gets indexed to inflation every year. So this gives you an idea of when to possibly start. Let's run through Mary's break-even analysis. Let's first take a look at Mary's plan. So we're going to have CPP at age 60 is our first example. Mary's got some registered assets here. So Mary's going to turn 60 later in the year. So we've got a couple months of CPP, but it's prorated because we've got a later birth date. But next year would be a first full year of CPP. We're going to get $8,600 starting at age 60. Mary's spending is 45,000 a year. Now, it's important to highlight, regardless of when Mary chooses to start CPP, we're not changing Mary's spending. We're not going to spend less just because we delayed CPP. That's not a factor here. We're going to be using Mary's registered assets to backfill the income that we've lost. And so that's part of that opportunity cost. So here we have some backfilling because we need to hit that target retirement spending. So we've got total income 52,000, and then we've got taxes 7,700. That gives us 45,000 a year after tax. So we've got CPP starting, old age security starting 65, full year 66. Net worth goes down over time. Not a great success rate, so we will see if this improves with a later CPP benefit. So that'll be the other thing to look at. So that's the first one, CPP at 60. And let's go to CPP at 65. So again, it's going to push out CPP. We're going to get a higher amount. So this is the higher amount, 13,440. We're not changing spending, so now we're drawing more from the portfolio, but same spending, 45,000 a year. Higher opportunity cost because now we're drawing 5 years instead of getting CPP. We have to draw more for 5 years. Now, the way we change that CPP age, super simple. We're using the AI strategies. We're just selecting the age 65 one. So everything else in the platform is the same. We're just saying 65 instead of 60. So pretty easy to set up these different scenarios. And then the last one is age 70. So again, we'll take a look at this one, pushes out CPP all the way to age 70. We do get a higher amount, so full year benefit 19,000. And of course, we're drawing down on the portfolio quite heavily for those 10 years. And again, we're just selecting that strategy. That's all we had to do here. So those are the three different scenarios, but the compare section is where we can do the break even. So let's talk about maybe what the break even is. So let's do 60 versus 65. This is our net worth line over time. We can see that the net worth declines a little bit faster in the CPP at 65 scenario, which makes sense. We're delaying CPP. We need to draw on other assets to backfill that income. And so, of course, those financial assets decline a little bit faster in that scenario until we get to 65. So that's our biggest opportunity cost. And then it starts to close the gap. We start to catch up because we're getting a bigger benefit as of age 65. And so slowly it catches up. But what we're interested in is where does that cross over? That's that break even point. And in this case, it doesn't cross over until age 75. So we started at 65, 5 years later. It takes 10 years in this case before we start to win out from that decision. It does look good over time, though. We do have additional financial assets later in retirement. So this is why having a longer life expectancy ends up favoring delaying CPP. Any questions before we look at 70, Chris?
No, none so far.
Okay, so let's look at age 70. So let's do CPP at 60 versus 70. So here we've got the same thing, but we've got a much bigger opportunity cost. So over time, almost $100,000 in opportunity cost with a lower net worth, lower portfolio value. Um, and when do we catch up? So when do we catch up between age 60 and 70? It looks like it's age 80 here. So instead of 75, it's 80 between 60, CPP at 60 and 70. Now, out of interest, let's do age 65 versus 70. So here we made the same decision. We're delaying in either case. We've got not quite as high an opportunity cost, but here the break-even point's even further out. It's age 84. So you can see that it ends up being quite interesting how far out we need to have life expectancy before this ends up being interesting. Now, it does help success rate. So, I mean, there are other soft factors here. Is it does give us longevity protection, gives us protection against higher inflation rates. So we do see success rate get better in these scenarios where we're delaying CPP. So even if we're not getting to break even if that doesn't happen, maybe we've benefited just from the peace of mind of knowing we have a higher benefit for those later years. So there's soft factors that you need to take into account here as well. Now, that was the first example. That was very conservative asset allocation. Let's see how this changes as we have a higher opportunity cost, higher rate of return. Unless there's any questions there, Chris.
No, none for the moment. We'll push them back a little bit.
Okay, so let's start with lower fees. So lower fees, higher expected rate of return. Instead of 2%, let's do 1% here. And so now we're at a 4.39% expected return, 1% higher, makes sense. Lower fees. We're going to rerun the three different examples. So we've got CPP at 70. We're going to rerun CPP at 65, rerun CPP at 60. And now let's go back to the compare analysis. Let's do the same thing. So slightly higher expected return, slightly bigger gap in terms of opportunity cost. So between 60 and 65, where's the break even? It was 75, now it's 76. So we've shifted it by a year just by reducing those investment fees, getting a higher expected rate of return. So again, if you're a more conservative investor, if you're at a big bank with higher fee mutual funds, maybe starting CPP later is a good idea. Draw down that portfolio because it's quite expensive the investment returns you're getting. But looks like if we start CPP at 65, wins out quite a bit in the long run. If we compare till age 70, bigger opportunity cost, again, higher expected rate of return, and we don't hit break even until 81. So a little bit later. And then 65 versus 70. Let's see, where do we hit break even? Age 85. So again, year later in that case. So even a slightly higher rate of return pushes out that break even point. Let's go a bit more extreme and see what it looks like with a very low cost portfolio. Let's go to investment plan. Let's reduce this to 0.25%. So maybe a all-in-one ETF. Let's do the same thing here as well. And let's also change the asset allocation. So let's do a more assertive asset allocation of maybe 80-20. So now expected rate of return 5.8%, quite a bit higher than Mary's original. And so let's see what that does. We'll rerun the three analysis, so the three different plans. So we've got CPP at 60, CPP at 65, CPP at 70. And if we go back to compare, quite a bit different here. Bigger opportunity cost, so quite a bit more, pushes out that break-even point until 78. So originally 74, now it's 78. So 4 years difference just because of the rate of return and investment fee assumptions. So big factor, somebody else might be starting CPP later. You might want to start it earlier. Maybe you've got higher investment returns, expected returns. Maybe there's a bigger opportunity cost. If we look at age 70 here, a really big dip there. And then all of a sudden it starts to win out at age 84, worth quite a bit towards the end. And then 65 versus 70, when do we hit that break-even point? Not until 91. So with higher investment returns, going from 65 to 70, I mean, it's definitely a decision you need to take into account investment returns, expected returns, investment fees. It has a big impact. But you can see how that changes, right? Just that one assumption around fees and investment returns, asset allocation has a big impact on this one decision. And that's just one of many factors, taxes, different asset allocation, different assets that you have, where they're located, all different factors. We didn't even cover old age security, but you can do the same thing with OAS as well.
I think this provides a nice level of nuance because if you read about this a lot, you might hear that, oh, with longevity, it's always better to delay till 70. Or you even see in the AI strategies that 70 is often the one that's recommended to say the best net worth. But when you're diving into the details of the compare, you can see with this example, it's a lot less dramatic than it might seem. And you might be more comfortable because another soft factor that I see with lots of clients is just wanting some other streams of income earlier on. It's more comfortable to not draw as heavily down on your retirement, on your investments. Having that extra CPP, that check that's coming in gives sometimes a nicer permission to spend versus feeling frozen and not spending as much if they have to take it from their investments.
Yeah, it's definitely something to think about. The psychological side is a big one, especially if financially it doesn't pay off until very late in the plan. Like certainly it's better if you live until 94, 95, but if it doesn't become better until 91, then you know, are there other considerations? Maybe. So this is where the best depends on what you want out of the plan and why it's interesting to run your own break even because depending on which type of Mary you are in this case, what type of returns you're getting, could be dramatically different, the decision you make. So, and that's only one nuance. That's only one factor. There's different factors, of course, as well. Super.
Oh, and a couple of questions. So, one is coming from a Quebec user. So they don't have CPP, they have QPP or Q in French. Will that make a big difference when using advice?
Yeah, so you can use the same detailed estimate. There are a couple nuances. When we do the CPP upgrade, we'll include QPP as well. But Mary's example here, we just put in the CPP number as of age 65. So you can do the same thing. You can grab your QPP estimate. You can use an external calculator to get a more detailed QPP estimate. You can just put that into the platform in the Discovery Tax and Benefits section. Just plug it in right there. So you can do this as well with CPP. You can get an external calculation as well. So definitely you can do the same sort of analysis. Most of the compare analysis that we're doing here is other factors. It's not the CPP amount that's changing dramatically. It's really other factors like rate of return assumption, fees, longevity. For OAS, it would be clawbacks that you might have between 65 and 70. Those will all factor into that break-even analysis. I think the compare chart just gives a really nice visual of those three different scenarios side by side. And you can really quickly see the break-even point because we can see those lines crossing. So to me, it just really helps visually drive the point home of, yes, financially, if you live to 95, one's better than the other, but where does that happen? Not maybe later until in the plan. So that's the nice thing to take a look at.
And then one user is a little bit confused about the break-even point, not quite understanding the concept here, but they're wondering if we can do a quick example of how to use a break-even point with an expected life expectancy of 80.
Yeah, so in this case, it doesn't really matter what you set for life expectancy. Now you can set that, so you can do it in projections, you can do it in advanced options, you can use the AI survivor scenario strategies. But we don't even really need to run the life expectancy because we can see here in this case, the starting CPP at age 60 scenario versus the starting CPP at age 65 scenario. These two net worth lines only cross over at 78. So even if you live until 80, you might look at that and say, well, there's not a huge benefit there. So maybe we want to start a little bit earlier, right? Where we don't have to draw down on the assets. But you can still use the same chart, even to go if it goes way beyond until age 90, 94, 95. But in the next case study, we'll show you how maybe you want to evaluate that differently in survivor scenarios as well. Yeah,
Great, thanks, Owen.
perfect. So let's flip over here. Let's look at the second case study. And we're just going to frame it up here and see if we have enough time left to go through it all. So we've got Jesse and Johanna, they're 62, retiring this year. And we've got 600,000 in financial assets. We're going to start pension here as well. That's going to be a specific factor. 2% investment fee, balance investors, RSP, TFSA. Questions around how do we draw down registered assets, but also when to start some of these benefits, CPP and old age security. So let's jump over to their plan and we're going to take a look. I'm going to first show you what the plan looks like. It's a little bit different than Mary's plan. So we've got CPP starting at age 65. So that's the default here for Jesse and Joanna. Remember, they're retired already. So they're age 62. They're already retired. They're going to delay CPP until age 65, OAS till 65. First year is a little bit lower because we're not getting a full year. We've got a pension, large pension, 75,000 a year. This is Jesse's pension. And Jesse's actually worried about life expectancy. So we're going to be running shorter life expectancy scenario for Jesse. Bit of a health concern in the past, worried about life expectancy, and worried about Johanna and what income looks like for them in a survivor scenario. So 75,000 a year, they're drawing on registered assets, bit of TFSA there, and the pension drops at 65, no more bridge benefits. So we're losing that bridge as of 65, but we're getting CBP and OAS. So end up getting less registered withdrawals, less investment withdrawals as of age 65. Let's take a look at their spending. Pretty generous, 120,000 a year almost. And that continues until 75, then it drops down to 95,000 a year. So fairly high spending in the plan, but they've got assets as well as a good pension, CBP and OAS. Net worth, they've got a bit over 500,000, so 600,000 almost. And they are drawing that down. So the first 3 years, you can see it's a little bit faster drawdown. Makes sense because they have a little bit, they don't have their CPP and OAS yet, so they're having a little bit more withdrawals for 3 years. The drawdown slows down a little bit, but does continue. And then at age 75, it stops because their spending goes down, which makes sense. It's typically what happens mid 70s, early 80s. After that point, because they've got the pension, CPP, and OAS, that actually covers all of their spending. So if we go back to spending here, they actually end up saving a little bit. There's a bit more room to spend there if they really wanted to. but it ends up going into the TFSA. So by the end of retirement, they do have quite a bit of TFSA buffer in their plan, but in mid-retirement, liquidity does go down in this case. They're spending more in early retirement, the pension's being topped up by registered and TFSA withdrawals, and so that's going to be a factor in their plan here. Now that's all with CPP starting at 65. So let's take a look at how we might optimize this plan. Let's make a copy. And while I do that, any questions at all, Chris?
There's a question around is there a way to have the software optimize the best CPP OAS break even, or do they have to copy the plan and adjust the AI strategies the way that we're demonstrating?
Yeah, so you can immediately, so we're going to do it right now. Let's filter on, and what we'd recommend typically when you're trying to figure out what the best plan is in your situation, use after-tax estate value. That's usually what we recommend ranking on first. And then you might evaluate these strategies. So we can already see here some of the top strategies are to delay CPP and OAS. So you wouldn't necessarily need to create multiple scenarios. You could do that if you want to do the visual break even like we did. Definitely then have three scenarios, look at those different start ages. But if you just want to look at the best time from an estate value perspective, you can just look at the AI strategies and what ranks top from an estate value perspective. The reason why we like estate value is that if you have more estate value, then later on we can add more spending to the plan as well. But because we're focused on CPP and OAS, let's filter on those two only. And let's go through and pick the top strategies here. So the top one from the get-go is CPP at 70 for Johanna. So we're going to enable that one. And typically, we recommend doing these one at a time. There can be confounding effects between different scenarios. So we don't want to do two at once. So now we're going to do CPP at 70 for Jesse. We're adding more estate value again. And let's do that one. So we're pushing out CPP here. We're drawing other assets. In the meantime, more opportunity costs, like we talked about already. It's saying we could get a little bit of a benefit from delaying old age security. So let's go ahead and do that. And for your plan might be different. If you've got a big capital gain between 65 and 70, it might be recommending 70 or earlier. It all depends. And then same thing for Jesse here. So let's delay all of these benefits until age 70. So although that does maximize their estate value over time, I do want to show you one of the downsides. They do lose a lot of liquidity by doing that. So there's a big opportunity cost. They do lose a lot of liquidity as well. It's not really a financial opportunity cost, but certainly psychologically a bit harder because they don't have a lot of buffer there for about 5 years. They do start to gain that back quickly, though, because they've dropped spending at 75, and all of a sudden they've got more CPP and OAS, and they've got a much bigger buffer towards the end of the plan. So if they're worried about end of life costs, long-term care costs, maybe this is a good decision. But for some people, they might look at that and say, gosh, that's losing a lot of liquidity within this plan. That's a lot of buffer that we don't have anymore. Maybe that feels a little bit uncomfortable. So let's rename this one. Let's say this is at 70. And let's maybe look at compare just to see those two side by side. So this is CPP and OAS. So we're going to look at the break even here for CPP and OAS delaying. So we had CPP at 65. It wins out CPP and OAS at 65. And we get to break even around age 84 here. So depending on investment turns, and also in this case, we're delaying OAS as well. OAS doesn't have as good a break even. So we've got age 84 here for the combined break even point. So again, interesting in this case for Jesse and Johanna. Now we're worried about life expectancy. So let's see how this all changes with a shorter life expectancy. So let's make a copy of this, and we do recommend doing this for your plan. Do a scenario with shorter life expectancy for both you and your partner. If it's just you, you might do it for yourself and see whether or not there's some different strategies. But let's say that we've got for Jesse anyway, a life expectancy of 80. And so again, we're worried about health. There's been some health concerns in the past. It looks like if they both have a long and healthy retirement, age 70 is a good choice. But let's now go to survivor scenarios and change that to age 80 for Jesse. And here we can already see there's quite an impact there. Remember, Jesse has the pension. So for Johanna, if Jesse passes away early, we're getting a lower benefit there. So let's recalculate this, see what it looks like. Doesn't look very good. So we're building up a little bit of buffer, but as soon as Jesse passes away, we quickly eat into that, and then Johanna's not in a good place by the end of the plan. And we haven't changed spending here, so that's one thing we do want to do is we do want to maybe reduce spending for Johanna after Jesse passes away. So we could add that here. And this is definitely dependent on your situation, but in this case, we're going to assume 15% or so. So on 95,000, let's maybe assume at age 81, the year after Jesse passes away, we're reducing spending by 15,000 a year. I'll just say until the end of the plan, which in this case is 95. So let's see if that helps improve at all. We've got 77% success rate, so definitely a little bit better in the case of a shorter life expectancy. And now not as much buffer as before, but better for Johanna for sure than in the past. So here we've got a reduction in old age security. We've got a reduction in Jesse's pension benefit and a reduction in CPP. Remember, when it gets combined, Jesse and Johanna both had very close to maximum CPP benefits. So we're seeing a big reduction there in the CPP survivor benefit. I do want to run one additional scenario. So now that we've got this scenario with Jesse having a shorter life expectancy, does that change the AI strategies? So let's make a copy of this and let's take a look. We're going to take a look at the same two AI strategies. So we're going to get rid of that one. Let's look at CPP and old age security. And already the top strategy here is no longer for Jesse to take CPP at 70, but at age 65. So if life expectancy is shorter and we know that that's likely going to be the case, we might make a different decision for Jesse on when to start that CPP benefit. Interesting, it's not 60, it's not 62 or 64, it is 65. So let's enable this for Jesse here, recalculate that. We're going to see that move back here for Jesse, and then age 66 for OAS. Pretty close between 65 and 66, but let's choose this top strategy here. So this is where you might reevaluate if you are expecting a shorter life expectancy. Maybe do a scenario with a long life expectancy, do one with a shorter life expectancy, but revisit those AI strategies because they might be different than they were before. And in this case, we're getting a little bit more buffer now. So not as much as we had in the first case, but a little bit more buffer. We've got a blended strategy. And Johanna's definitely looking a little bit better from a long-term estate perspective. Let's rename that one CPP OAS, and this one's at 65 and 66. Anything I missed on that one, Chris?
No, I just think that just to highlight this is where we can start to say, okay, this may not be optimal because if we go back to our original live till 95, and we have Jesse taking it at 60, 65, that's not the optimal for the long-term net worth side, but we're balancing multiple risks here. And we might be balancing specifically for these clients that are saying, we're worried if Jesse passes away early, that there's going to be a reduction in some of these benefits. So taking Johanna's later at 70, Jesse's earlier, we start to do what we like to talk about a lot on these case studies, this sense of saying it doesn't have to be optimal by the numbers. What we want to do is make a plan that works and balances these risks. So this is how you can start to get to that truth a little bit and figure out what might make the most sense.
Yeah. Yeah, every situation is going to be a bit unique, and the factors in your plan might be different than this one. Maybe there's not the same pension benefit, there's not the same reduction, maybe it's a bigger reduction. Um, but yeah, it's an interesting trade-off is that often the best option is not the best from a financial perspective, but what you balance out in terms of like psychological benefit and how you want to draw down those assets. And even to Chris's point, getting a bit of that income earlier might just feel a little bit better, even though it's not the best plan from an overall estate perspective. So it does work out better in this case. So we've got CPP at 65, 66, OAS at 66. We can't see it does work out better in the long run if we've got that shorter life expectancy. Maybe that's enough. Maybe that's enough psychological benefit that is worth the trade-off for them. Perfect. Any other questions at all, Chris?
No, we've actually managed to answer them all. If you have a last question, please feel free to send it in to us. We might have a few more minutes to answer something. But if we don't, thank you so much for joining us. We always really appreciate everybody joining us on a Wednesday evening to talk about finances. Um, Tickled that you're all interested enough to come and join us and nerd out about this stuff. So we hold a couple of these webinars every month, office hours for users on the platform, and then a case study webinar. Next month, we're going to be looking at spending. So retirement spending is going to be the focus of the case study webinar. Lots of directions we can go with that. So we'll show you how you can model that on the platform. Quick question here. Somebody's asking what inflation rate we're assuming.
Yeah, so that gets updated every year in the platform. It's based on the FP Canada assumptions. At the moment, for the base projection, it's a 2.1%. And I say base projection, so what I'm talking about is the net worth over time. But in the success rate, we're using historical periods, so historical stock returns, bond returns, and inflation rates. So some of these lower lines would include higher inflation periods, including the 1970s, and potentially worse. So periods of very high inflation, very low real returns will be captured in the success rate analysis itself. But yeah, good question. Right now, the net worth assumes a 2.1% inflation. Same for spending, it's going up 2.1% a year as well.
And then we did have a last question about whether we had any info about any improvements that we're planning before the end of 2025.
Oh, lots of improvements. Lots coming. Yeah, lots of new features, some very interesting ones for year-end planning. So we will be posting those in the Reddit community when those are available. But yeah, lots of plans over the next few months and into early 2026. So yeah, lots of stuff coming, lots of good features. Don't want to drop too many hints now, but there will be some, again, around year-end planning, tracking progress. So yeah, lots of fun stuff coming that hopefully should be, yeah, interesting.
And if you missed it, we just released some new features on Monday. So we're just a couple of days in. We'll talk more about those in office hours next month. So in a couple of weeks, we'll introduce all those features, but check out the Reddit post on it if you want an introduction. There's some really cool ones, including the ability to lock your scenario, which honestly, it opens up a whole bunch of really interesting ways to use the platform that we'll demonstrate a bit more during office hours, but to have some fun with that in the meantime. Thank you so much for joining us and have a great night, everybody.
Thanks, everybody. Have a good night.